Hey guys, I'm Mark.
And I'm Jackie.
And welcome to The Journey to FI. What if I told you that you could become a savvy investor by the end of this video?
I'll tell you you're full of
I promise I'm not. When most people think about passive income, they are thinking of rental income or renting out a room on Airbnb or selling courses online. But what most people are missing is the easiest source of passive income there is, investment income.
So what's the secret?
VT Sachs.
VT Sec?
Nope, VT Sachs. VT Sachs is Vanguard's abbreviation for their Total Stock Market Index Fund. An index fund is a type of mutual fund or electronically traded fund, or ETF, that tracks one of the market indexes. For example, you might have heard of the NASDAQ 3000 or the S&P 500. The difference is VT Sachs tracks the entire market as a whole rather than just the top 500 companies or those in a specific industry.
So essentially, VT Sachs is a tiny portion of every company in the United States.
But what makes VT Sachs special?
VT Sachs is special for two reasons. First, diversification, and second, it's passively managed. A quick example of diversification is spreading the risk among many areas instead of keeping all of the risk in one area. So with VT Sachs, you're spreading your risk by investing in a small portion of all the companies in the United States versus just investing in a single stock.
So what's the point of this? Let's take Blockbuster for example. If you had invested in Blockbuster in early 2000, you might have thought you were doing pretty well. The stock was increasing, it was paying you dividends, and life was pretty good. But a failure to get with the times and hop on board the streaming service train left Blockbuster in complete financial ruin. They declared bankruptcy, and if you owned any stock in them, that essentially went to $0. Now consider if you had instead invested in a total stock market index fund like VT Sachs. Yes, Blockbuster would have gone bankrupt and you would have owned a part of Blockbuster, but you would have also owned a part of Microsoft, Apple, Tesla, and a number of other companies that have done really well over the past couple of decades. As you could imagine, investing in a total stock market index fund would have left you a lot better off than investing in a single company like Blockbuster. And next we have passive management. Passive management means that there's no stock pickers hand-selecting stocks for you to invest in, like there are with actively managed mutual funds.
So what's the problem with having smart people pick stocks for me?
Two things. The first thing is that they expect to be paid. The second thing is that smart people picking stocks for you is no guarantee that that'll outperform the market. In fact, it has been shown numerous times that actively managed mutual funds underperform passively managed index funds, especially when you account for their higher expense ratios.
What's an expense ratio?
An expense ratio is the amount of money that's taken from your fund every year to pay the fund operator. In the case of actively managed funds, that money is going straight to the stock pickers. In the case of passively managed funds, since there's no stock pickers, you're barely paying anything at all.
For an example, for a fund like VT Sachs, your expense ratio can be something like 0.04%, whereas if you were to pick a similar actively managed fund, your expense ratio could be like 0.5%.
And this 0.5% might not seem like much at first, but this can add up to tens of thousands of dollars in 10, 20, and 30 years when you retire. Don't believe us? How about Warren Buffett? Warren Buffett has been quoted saying,
"In my view, for most people, the best thing to do is owning the S&P 500 index fund."
End quote.
Uh-oh, he mentioned the S&P 500 index fund, but we're talking about VT Sachs. Are we going against
Warren Buffett?
Maybe a little.
Not really. The S&P 500 makes up about 80 to 85% of the total stock market. So both are actually pretty much identical. Each year, the total stock market returns about 8% on average to its investors. Now keep in mind, this isn't average, so some years will be below 8% and some are even negative, while other years, like the previous one, can be far above 8%. So when you invest in VT Sachs or the S&P 500, or anything for that matter, you really should only invest with money that you don't need for 5 to 10 years. This is a long-term investment, not a get-rich-quick scheme.
So how can you take advantage of VT Sacks? Something we do is whenever we invest in our 401k accounts, our IRAs, or whenever we have extra money in our savings account that we want to invest in brokerage accounts, we put this money in a VT Sacks or comparable index fund.
And that's a good point about comparable index funds. VT Sacks is Vanguard's version of the total stock market index fund, but most brokerage firms have their own version of a total stock market index fund. For example, Charles Schwab uses SWTSX.
And Fidelity uses FXKAX.
So back to passive income. I mentioned earlier that the stock market as a whole returns about 8% on average. So when you invest in a total stock market index fund, like VT Sacks, you can expect every $1 that you invest to generate an average of 8 cents every year. The best way to think about this is that every one of your dollars is like a little employee. It's your employee. They're working for you, and they're making you 8 cents every single year. Now multiply that by 100, they're making you $8. Multiply that by 1,000, they're making you $80, and so on. So you can see how this is the easiest form of passive income there is. There's really nothing else to it other than investing your money in the stock market.
So as you can probably tell, we think VT Sacks is amazing.
But everybody is different and everybody has unique circumstances. For instance, if you're closer to retirement, then you might want to include bonds or US Treasuries in your portfolio as well. But for us personally, we feel like VT Sacks is the most powerful piece of investment knowledge that exists.
So let's summarize. First, investing in VT Sacks is the easiest form of passive income.
Second, VT Sacks is less risky than investing in individual stocks due to diversification.
And third, funds like VT Sacks generally average returns around 8% a year, and they have lower expense ratios than their actively managed counterparts.
And lastly, we personally invest any money that we don't need in the next 5 to 10 years into VT Sacks or a similar fund.
So we hope you found this video helpful. If so, subscribe to our channel and tap the like button.
Thanks, and stay tuned for the next one.